All right, welcome to the Skill Incubator's course on Bitcoin basics. In this course, you're going to learn exactly what Bitcoin is and maybe even more importantly, what it is not. There's a lot of misconceptions, and so we're going to start by talking about the Bitcoin protocol and how that works. We're also going to dive in and really explain why Bitcoin has value, why people trust it so much, why it's gained so much popularity and use by user growth over the past several years. And then we'll also talk about some of the basics of how to actually buy and sell Bitcoin, how to buy your first Bitcoin, how you can sell it, also where to store your Bitcoin. And then finally, how to actually profit with Bitcoin and the new cryptocurrency economy. So this is some really exciting stuff. I'm glad you're here, and let's go ahead and dive in. So before we get started, I just want to introduce myself. My name is Chris Dunn. I'm the founder of Skill Incubator, and our mission is to help people learn skills to help them thrive in today's economy. I'm a Bitcoin investor and entrepreneur, and I actually first heard of Bitcoin in 2011 from a hedge fund buddy of mine. And after actually being a little bit skeptical of Bitcoin for several years, I actually invested and traded in and out of Bitcoin and have developed products and services around the new cryptocurrency economy. My background is actually in investing and financial markets, and I have about 15 years of trading and investing experience. And I also want to introduce you to Rocky Darius. So Rocky is the cryptocurrency mentor here at the Skill Incubator, and this guy is just really interesting because he's been living 100% off of his Bitcoin income for the past few years, and he's a full-time cryptocurrency trader, investor, and analyst. And his personal blog is cryptohustle.com. So just some final notes here. The best way to master this course is just to take your time and go through each module and each lesson step by step. And if you have any questions or need any help, feel free to reach out to us and ask questions. And finally, most importantly, is to take action. Knowledge is helpful, but action is what's going to get you from A to Z. So with that said, I hope you're excited, and let's go ahead and jump in to the next lesson.
So let me tell you a little bit about the history of Bitcoin, why it came into existence, and what it is exactly. So Bitcoin is a type of money that's not controlled by banks or governments. And, there's been other forms of money in the past where banks and governments didn't control it. You have local community currencies, stuff like that. I mean, you could technically use anything as money because money is just a medium of exchange, right? The only thing that gives money value is that a community of people decide that it has value, right? So as long as enough participants in a society agree that something is worth something or is a medium of exchange, it can help facilitate trade and make our lives a lot easier. I mean, imagine if you had to go out and haggle every day just to get some milk and eggs. You got to find some kind of resource to haggle. I mean, you spend most of your days just trying to get groceries, right? So money makes things very convenient as long as it's sound money, smart money, right? But Bitcoin is the first time that we've had money not controlled by banks and governments on an international level where anyone in the world could participate in this. It's actually a global network. And it was created in 2008 after the financial meltdown that happened with the housing bubble collapse and all these banks going belly up. So it was kind of created as a remedy. And it was founded by an anonymous, mysterious figure named Satoshi Nakamoto. Nobody knows who he, she, or they are. They disappeared out of the public eye, but they gave us this gift. Now, Bitcoin was an evolution that came out of the cypherpunk movement. And for those of you who don't know what that is, the cypherpunk movement was this activist movement amongst cryptographers and hackers that started in the 90s. And their whole mission statement was to use technology and cryptography as a means to maximize human liberty and privacy. So one of the things that they've been working on since the late 90s and the 2000s is a form of cryptocurrency, is a form of decentralized money that uses advanced cryptography, right? And this was a process that lasted for for probably about a decade or so. And then Satoshi Nakamoto came out with the first functioning working model, which was Bitcoin. But it was an evolution of other prototypes and models such as BitGold and Hashcash. So Bitcoin is completely decentralized. And what that means is that there's no central authority that dictates what Bitcoin is, right? So how that works. So for example, if you look at the money in your bank account, the credits or IOUs that are in your bank account, this is a centralized bank, so it's a corporation who's keeping tabs of this tally, but it's also, those credits are held on a centralized server, right? So whereas Bitcoin is a decentralized network, it's open source, which means that anyone can use the code, they can modify the code. There's been a whole series of other cryptocurrencies called altcoins or alternative coins that arise. It created a whole industry. Various corporations and banks now actually want in, and they've been trying to get into the blockchain industry. And how decentralized works is that it's a network that's controlled by miners and nodes. So what a node is you have the software, and on the software you have an entire record of the ledger, right, of every single transaction that's ever happened on the network, right? And these nodes also have all the rules coded into it in the software, and they communicate with each other to make sure that other nodes and miners are following the rules, that everyone's following consensus. And what miners do is they keep the ledger secure by confirming transactions and stamping them on this ledger. And what they do is they give what's called hashing power, which is like a lottery where they just throw out billions of hashes a second to try to solve this really, really advanced cryptographic math problem. And as soon as one of these, and they use these specialized machines called ASICs to do this, and as soon as a miner finds or solves this problem, what ends up happening is that all the transactions that happen on the network, they kind of timestamp, they bunch them together into a block and they timestamp it on the ledger, right? This is why it's called the blockchain, because then the math problem is evolving from all the previous blocks on the chain, right? So they do this to secure, and they put millions of dollars to secure this network because it is a public ledger, right? And it's the first time we've had such a public ledger. They do this to keep the ledger immutable. What that means is that you can't forge the ledger, you can't reverse transactions or forge coins or do anything like that, because they're perpetually moving the ledger forward, right, by solving this math problem. So that's basically Bitcoin in a nutshell. How does Bitcoin work? In order to truly understand Bitcoin, we need to look at the underlying technology, which is called blockchain. A blockchain is a decentralized ledger system. And so the thing that makes it decentralized is that instead of one central party or a handful of financial institutions maintaining this ledger, it's basically any participant on the network has their very own version and copy of the ledger. And this ledger is built into the core software. And this software also acts as a wallet and has all the rules of the ledger encoded into it. We call this software a node, and anyone can run a node on their computer. And so what this looks like is that everyone's ledger is communicating with everyone else's ledger and with the miners to ensure that everyone has an accurate copy of the ledger and that all the participants are following the rules of the network. The more nodes that you have on this system, the more decentralized it becomes. So for example, if there's only 2 people running nodes, it's not very decentralized. Whereas if you have thousands of people running nodes, it's a lot more decentralized and makes it very, very difficult to shut down the network, because you'd have to go after all the various different people who happen to be running a node. And also, let's just say that the internet were to shut down tomorrow. All you need is one copy of this ledger, an up-to-date copy, and you could start the entire system over again and pick up where we left off. And so then you have miners, and miners help secure new transactions on the ledger to prevent counterfeiting or double spending. And the way they do this is they keep the ledger perpetually moving forward by contributing computer power to the network. So it becomes exceedingly difficult and extremely expensive to try to rewind and move this ledger back because it's constantly moving forward. And that's what gives the ledger immutability, which means that anything put on the ledger is permanently time-stamped and cannot be changed. And so this is the underlying power behind Bitcoin and what makes it so remarkable as a decentralized financial system. And so how miners contribute to the network is they contribute hashing power to help solve a complex cryptographic math problem. And solving this problem is a lot like winning a lottery. So they generate computer power to the network that just creates billions of alphanumeric hashes, and eventually one of these is the right hash or series of numbers to be able to solve this problem. And that every single time a problem is solved, a group of transactions that happened on the network, they're bundled together and they're recorded on the ledger, time-stamped as a block. And so all these blocks of transactions that we have, they're linked together with other blocks on the chain, and this is why it's called a blockchain. So these miners, they're also incentivized to help secure the network, so it's not a voluntary act. Every time a miner solves a block, they are rewarded with the creation of new coins. So this is how the creation of Bitcoins comes into existence, right? It's from miners solving blocks. And so this is a reward mechanism to ensure that everyone is incentivized to not try to game the system, because if they game the system, then the Bitcoins they mine become valueless and they end up just wasting a bunch of money on hardware and electricity. And so nodes, anyone who's running a copy of this ledger, they ensure that miners follow the rules and don't game the system. And so there are natural checks and balances in the system between miners, the developers, and node operators, which also happen to be participants on the network. And Bitcoin blocks are solved approximately every 10 minutes, which makes it a self-regulating system, a system that's regulated by mathematical algorithms as opposed to political whims. So let's just look at the evolution of Bitcoin mining. So initially, you could contribute to the network in the early days in 2009 and 10, just with the CPU, just with your basic computer, a laptop or a home computer was enough, because there weren't a lot of participants on the network. Now, the interesting thing is, because it's a self-regulating system, the more people who contribute computer power to the network, the difficulty goes up to ensure that blocks are solved still approximately every 10 minutes, give or take. Then people realized that if they use graphics cards, known as GPU, then they could actually generate more hashes and have a better chance of solving blocks. So we evolved from CPU, and that no longer became profitable, into people building their home mining rigs. Eventually that evolved into FPGA, which eventually evolved into these specialized supercomputers called application-specific integrated circuits. These are specialized computers whose only purpose is to generate hashes to solve Bitcoin blocks. That's all they're good for. And eventually that became very competitive. And now what you have are people who have huge data centers, or they rent warehouses full of ASICs to be able to mine this. You can still mine at home, but it's more of a hobby. If you want to do it as a business, you definitely have to likely rent a warehouse and manufacture your own ASICs. All right, so if you're going to get into mining as a business, there are several factors you need to look at in order to make a return on investment. So the first thing is the cost of hardware. So that's the very first cost that you'll have when setting up a mining operation. Then you have to make sure that your electricity rates are competitive. So you might want to mine in a jurisdiction that has the lowest electricity rates. You need to factor in the network difficulty to ensure that your hardware is up to par, because if you have outdated hardware, it's really not going to do any good. And look at the price of Bitcoin, right? If the price of Bitcoin is too low, it might be difficult to make ROI based on the block rewards. And also the mining pool fees. Oftentimes miners will pool their resources together so that they can solve more blocks more frequently and get a constant stream of Bitcoin trickling in based on their share and what they're contributing to the pool. So we also have to look at the Bitcoin block rewards that halve every 4 years. So initially the rewards were about 50 Bitcoins, then it got halved to 25, then it got halved 4 years later to 12.5, so on and so forth. And this is just going to keep on happening every 4 years until the block rewards are incredibly minuscule, and then miners will have to just subsidize themselves from fees alone. So here's an interesting site. It's bitcoinblockhalf.com. If you want to keep up to date with the amount of Bitcoins in circulation and when the next block halving is, it shows you all the statistics in order to be able to do that. So it'll show you the total Bitcoins in circulation, the total Bitcoins ever to be produced, the percentage of total Bitcoins mined, total Bitcoins left to mine, total Bitcoins left to mine until the next block half, the Bitcoin price, the market capitalization, which is just price times supply, and then the Bitcoins generated each and every day. So let's look at what it means to own Bitcoins. All coins are stored on the ledger through cryptographic key pairs. So a public key is what you use as a receiving address, and you give that out to people and they can send Bitcoins to that public address. But your private keys are what allow you to unlock the Bitcoins on the public ledger and be able to send them to someone else. So all public keys and coins can be seen by anyone. So you don't have a name attached to your public address, but everyone can still see that public address and all the coins that are on it. So best practices say if you're going to receive new coins, you should generate a new public address. And then private keys are what allow you ownership to be able to unlock and send those coins to someone else on the network. So here's an example of a public and private key pair. Basically, they work together kind of like a lock and key. So this is a public address that you would give to people if you wanted them to send you Bitcoin. And then the private key is what allows you to unlock that and claim ownership of it. Oftentimes, these private keys will be hidden and encrypted in your software wallet, but you can also get access to them. How do you buy and sell Bitcoin? One way to buy Bitcoin is to meet in person, and there is a site called localbitcoins.com. The benefits of doing this is that you could actually buy Bitcoins anonymously, but it's important if you do this that you should meet in a public place and wait for several confirmations before handing over your cash. The downside to this is that there's usually a premium where sellers will sell their Bitcoin for 5 to 10% above spot price. So you might not get the best price using this method. Then you could also purchase Bitcoin on online exchanges such as Coinbase, and we have a tutorial on how to do this in another section. To be able to buy off of online exchanges, it usually requires full KYC verification, which is know your clients, and that requires sending in a copy of your identification. It's very similar to buying on the New York Stock Exchange or NASDAQ. And there are also decentralized online marketplaces as well, such as BitSquare, which are decentralized exchanges. But the downside to those is that there's not a lot of liquidity on the order books. If you're interested in finding various different Bitcoin exchanges, you can go to a site called coinmarketcap.com. Just click on the Bitcoin tab, click on Markets, and it will show you all the various exchanges where you can buy and sell Bitcoin. Some of these are also altcoin exchanges because most altcoins are paired against Bitcoin, but you will find exchanges where you could also buy and sell Bitcoins. And most jurisdictions have their own local exchange. So look around to see if there's an exchange in your area where you can trade for your currency. Hope you enjoyed this video, and I'll see you in the next. Cheers.
So let's talk about what is money. You know, money at a very fundamental level is just a social construct that a society creates. You know, it's something that people in mass kind of agree on what money is, and it's a medium of exchange. It's a way to transfer ownership and to buy and sell goods and services from each other, and it facilitates the ease of trade. You know, it took us from, you know, a bartering system to a system of accounting, and over the past several thousand years of history, documented history, there have been many things that have served as money. Everything from seashells to gold coins and bars to stacks of produce to more recently fiat currency like the US dollar, to credit, you know, digital credit. And money is constantly evolving with the pace of technology. And I think what makes Bitcoin and blockchain technology and cryptocurrencies so interesting is that this is quite literally the biggest financial innovation of the past century or more. You know, over the past several hundred years, we basically had fiat currency and currency that was, you know, paper currency that was backed by gold, meaning if you had a note, it was actually represented ownership of some piece of gold somewhere. But now money is evolving and becoming more digital. And so that's where Bitcoin is really starting to shine. So let's talk about the 4 properties of money. You know, these are just kind of on a fundamental level 4 things that you need to have to actually have something that can serve as a reliable source of money. Number 1, you want something that is durable, something that retains its shape, its form, its substance over an extended period of time. So, you know, kind of a silly example, bananas, you wouldn't really want to use as currency because a banana is going to rot in a week and you're not going to have your money anymore, right? That's why gold has been such a good source of value and a store of wealth over time, is because it retains its shape. It's beautiful, it's solid, it doesn't go anywhere. And the same thing is true about Bitcoin. You know, Bitcoin is forever lives on the blockchain, and I guess the only way that you could completely eliminate Bitcoin is if you got rid of the internet, which even if you did that, there's ways to still preserve the blockchain. So Bitcoin is absolutely durable. It's going to retain its shape and its protocol and the way that it operates forever and ever. And it's also divisible. So you want something that can be broken down into small parts. And this is where gold kind of fails in its ease of use. You know, it's not only dangerous to carry around a block of gold, but it's also hard to buy a cup of coffee with it. You know, like, how do you know how much gold to chip off? And it's not very efficient, right? But Bitcoin is actually divisible down to the 8th decimal point. So it's basically infinitely divisible to a certain degree. Transportable, you want money that can be easily moved from one location to another. And, you know, just like you can transfer credit or you can transfer dollars digitally, Bitcoin is probably the most advanced piece of technology when it comes to transferring value internationally. You know, as we've discussed earlier, you can move millions of dollars around the world in a few minutes for close to free, where the old school system was, you know, you had to go to your bank, you had to fill out all these documents, you had to pay a wire fee, which is just ridiculous. You know, you have to pay for permission to send your own money somewhere. And then it can take days to clear, or weeks if you're sending money internationally. And if you've ever purchased a home or moved a large chunk of money, now with government intervention, they're making it even more of a pain to move your own money. So the fact that Bitcoin is so easily transportable is a huge benefit. And then finally, non-counterfeitable. Basically, you want some money that cannot be easily duplicated. And, you know, for example, the US dollar, they go to many lengths to make paper money that cannot be counterfeited, even though that's not 100% foolproof. With Bitcoin, this is where Bitcoin really shines. You know, there were prior examples of digital currencies dating back to the 80s, but Bitcoin is the first one that solved the problem of what we call double spend, meaning you couldn't spend the same Bitcoin twice. It's not counterfeitable. So because Bitcoin has all four of these properties of money, people are starting to look at this and go, wow, maybe government issued money isn't necessarily the best form of money, right? And again, I've said this hundreds of times over the past few years, and I'll continue to say it. I think currency competition and decentralized digital currencies are probably the best thing to happen to capitalism this century. And let's just talk about that. Let's talk a little bit about centralization versus decentralization. Centralization, whenever we talk about it in the context of money and government and power, it's basically a top-down pyramid structure of power. You have the select few at the top that have the most power, and then at the bottom you have the masses that have very little to no power. Decentralization is a network of interconnected dots or hubs or people or nodes that share equal power. Peer-to-peer systems share equal power, and individuals lose autonomy in centralized power systems. Whenever you have a king or somebody sitting at the top, people at the bottom lose a lot of power, where decentralization is a self-selecting meritocracy, meaning it doesn't require someone else's permission. You don't need a king or a president or a governor to give you permission to do something, right? In a peer-to-peer system, if you participate in the network and you follow the predefined network's rules, you can move freely in that system. And so technology is moving us towards more decentralization. Think about the internet. Before the internet, you had to go through if you're in America, the post office, right? The USPS to send mail. Now, without anybody's permission or really any cost, you can send an email anywhere around the world instantly for free. And that's what's happened to money. We are going through a period in time where we're seeing the democratization of money, meaning we're taking the power from a centralized hierarchy and decentralizing it. Even the media, where people used to have massive budgets and just a lot of talent and permission to have a radio show. Now you have tens of thousands of podcasts, and TV shows have now morphed from very expensive kind of good old boy networks to YouTube. Anybody can have a channel, right? So decentralization is just another powerful tool, and that's one of the many reasons that Bitcoin has so much value. So if you are not familiar with this term, fiat currency really refers to any currency that is backed by the faith that you have in a government on a very essential level. Now, look, money is kind of like religion in some sense, that people will argue tooth and nail what real money is, and some people have very strong beliefs that money is only government issued money, or some people are gold bugs and they say only gold is money. But fiat, the meaning behind this is let it be done. Basically, it derives its power from the government and their ability to tax people. And fiat currency is created by central banks through a process, at least in the States, called fractional reserve banking. And we're not going to go into too much detail in this course about fractional reserve banking, but we'll just say kind of at a high level that this is centralized form of money. And the problem that you have with centralized money is where we are today is we are now, tens of trillions of dollars in global debt. We're starting to see many more bank runs, government and bank bailouts and bail-ins, hyperinflation, as we've seen in Venezuela, Zimbabwe, and there's also a war on cash, like the government of India trying to do their best to crack down on corruption recently made, I believe, about 85% of their paper money void, and so people had to come in and turn in their money for new paper money, and if you brought too much in, they just kind of conveniently taxed you on that. Also, corrupt politicians and central banks that don't have people's best interests in mind. So Bitcoin, on the other side of that coin, is trustless money, meaning you don't have to trust any individual to do the right thing or to act in accordance with what is best for you. Money governed by a predetermined social contract and regulated by math instead of politics. That's really what Bitcoin is about. It's a math-based, fully transparent protocol. So, the supply cap, meaning how many Bitcoins are ever going to be mined was issued at its inception in 2009, right? So you know exactly how much Bitcoin is going to be coming out over time, where here in the States, we've really been kind of taken by surprise at the speed in which the government has printed money. So Bitcoin being a transparent, open sourced currency that's based on voluntary cooperation by miners, right? The reason why Bitcoin works is because people look at it and they go, you know what, we trust this. We can audit the code, we can look at how it works, and it makes sense. That's why it has its value. Not because you had some king or president or central banker that stamped his or her approval on it. It's because people look at it and they say, yes, we as a people understand and we basically agree that this has money because it has the properties of money. We can use it easily and freely. And oh my goodness, wouldn't you know it, it's actually better than fiat currency in a lot of cases. And the nice thing is there's checks and balances between miners, nodes, and developers. This is something that is quite literally democratizing money and giving the power back to the people. It's really incredible. And individuals are incentivized to follow the rules. People inherently act in their own best interest. And in the Bitcoin protocol, it's in your own best interest to support the network. So that's what people do. And Bitcoin is just a great example of a successful autonomous free market, meaning a market that doesn't need permission from the government to do something. So just kind of some final advantages of Bitcoin. One of the biggest ones is you maintain 100% control of your money. There's no downtime. There's no spending limits or arbitrary restrictions or forms or fees that you have to pay. It is borderless, permissionless money, meaning you can send money cross imaginary government borders without permission. And it's also acting as a store of value. Like gold has been a store of value for thousands and thousands of years. People are starting to look at Bitcoin and go, you know what, even though this is just digital, this could actually act as not only as a currency and a medium of exchange to buy and sell stuff, but you could actually store your wealth in it. Now, Bitcoin's price has been very, very volatile, but it's also been one of the best performing investments over the past several years in the world. And so it's also a non-correlated asset, meaning it's a completely new asset class. And you can use this as a hedge in a diversified portfolio. You can use it as a hedge against inflation. You could use it as a hedge against overtaxation, right? So because of these things, people are just really starting to see a lot of value in Bitcoin.
What are Bitcoin wallets? What is a Bitcoin wallet? So a Bitcoin wallet is equivalent to a decentralized crypto bank account. What it is a piece of software that you keep on a device and you use it to store your public and private keys so that you can be able to send and receive coins on the network. There are various different types of Bitcoin wallets. Here are 8 main types of wallets ranging in various degrees of security. The first are the wallets that are generated on exchanges. So every exchange that you have, you can generate a wallet where you can withdraw and deposit coins. Now, these are the least secure because it's allowing someone else to manage your private keys for you. So if something happens to them, you could potentially lose your money. So there is counterparty risks that you need to manage. Then you have browser wallets, which are just wallets generated on your internet browser, as well as mobile wallets that you can have on your phone. These two types of wallets should be treated as hot wallets or petty cash, where you just use for smaller size transactions because they're not as secure as some of the other wallets. Then you have the core client, which is the main software written by the Bitcoin developers. You have the lightweight client. And the difference between a core client and a lightweight client is that the core client has an entire record of the whole ledger or blockchain, whereas the lightweight only has a partial record. Then you have brain wallets. So you can take any phrase, any words, and you could generate these into a Bitcoin wallet with a public and private key pair. These aren't really considered secure because humans don't tend to create things with a high degree of randomness. That said, there are types of wallets called deterministic wallets that will generate based on 12 or 24 words. These are a lot more secure than just trying to create your own brain wallet because these words are randomly generated. Then you have paper wallets, which are wallets that you can generate offline on a piece of paper and just be able to send your coins to the public address. And then you have hardware wallets. And hardware wallets, what they do is they isolate your private keys from the internet. They give you all the security of a paper wallet, but the ease and convenience of using something like a browser wallet. So here are various different degrees of security, 3 degrees. So hot is private keys that are managed by third parties. So using an exchange, for example, you should never keep all your Bitcoins on an exchange and only use what you're trading, and make sure that you manage counterparty risk. You can do this by diversifying among several exchanges and also keeping the majority of your coins offline. Then you have warm wallets, which is managing your own private keys on your own software on your computer, but the software is still connected to the internet, so there could still be vulnerabilities. And then the most secure is cold storage, which is isolating your private keys by keeping them offline entirely. You can do this through paper wallets or hardware wallets. So here are a few things I need to know about the core client. So Bitcoin Core Client is the main Bitcoin software that's written by the Bitcoin developers. It can operate as a node on the network, so it has all the rules of the Bitcoin network encoded into it. And it also keeps a record of the entire blockchain. So obviously that requires some storage on your computer as well as bandwidth for your home internet plan. And it should always be encrypted and backed up, so you'll want to password protect it. And you'll have to, every time you generate new transactions, you'll have to download regular backups. Make sure that you have a clean computer or a dedicated computer, so you want to have it free from viruses. So here are some of the pros of the Core wallet. It's maintained by Core developers, and there's over 100 volunteer contributors who provide code for this wallet. It's considered one of the most secure software wallets out there as far as software is concerned, because it has all the rules of the network and the entire ledger, so it doesn't have to trust anybody else's record of the ledger. And it has a record of the entire blockchain, so that's a benefit. And it can be used as a node to help secure the network. So if you want to contribute to the network and make sure that everything's running smoothly, you can volunteer to run one as a node. Here are some of the cons to a Core wallet. It can literally take days to sync. Basically, it has to catch up. When you first download it, it needs to catch up on about 8 years worth of transactions, so that can take a while. It requires a lot of storage on your computer, so you want to make sure that you have either a dedicated computer for that or the right amount of storage on your computer. And it also consumes bandwidth, so it's constantly communicating transactions with the network, and if you don't have a good internet plan, it will consume a lot of bandwidth. And it also requires a constant backup every time you generate new transactions. All right, things to know about a lightweight wallet. What a lightweight wallet is, it's software that stores private keys locally on your computer, and it only requires a partial copy of the blockchain. And so as a result of that, it really needs to rely on communicating with full nodes, which are core clients. And one of the most popular forms of lightweight wallets is called Electrum. And Bitcoin has an Electrum, but not every altcoin out there has a lightweight wallet like Electrum. So here are some pros to using a lightweight wallet. It doesn't require a lot of space or bandwidth because it's not downloading the entire blockchain and constantly relaying transactions across the network. It's a lot easier to use than a Core wallet. It has more features to it, so it becomes very easy to be able to sweep your private keys, for example. And deterministic seeds don't need constant backup. So these are generated either from 12 or 24 word seeds, and you could use those as a backup, and all your addresses that'll be generated will come from those that seed, which is a private key. And let's say something were to happen to this wallet, you can restore all your coins just by downloading a new copy and putting in the deterministic seeds. So that's different than a Bitcoin core client, whereas if you lose that and you don't have a backup copy of it, then you won't be able to restore it. But here are some of the cons. You need to trust full notes. So because you don't have a full record of the ledger, you need to trust other people to maintain that. It relies on communicating with a server. So obviously if that server's down, it might not function. And it doesn't contribute to secure the network like a core client does. And it's usually a smaller team of developers than the core volunteers. And not every coin that's out there has this option. So Bitcoin has it, but there are other cryptocurrencies that don't have this. All right, so let's look at paper wallets. So paper wallets are wallets that you'll generate offline to keep your private keys isolated from the internet. So these are generally considered very secure. So the pros are they're unhackable if done right. So you have to make sure that they're done right. They're completely anonymous. Nobody can see your IP address or anything like that when you're generating them because they're created offline, and they can be physically traded. So you could technically just give someone a paper wallet in exchange for cash or something like that, and then they could sweep the private keys themselves, and that would be kind of like an offline transaction. So here are some of the paper wallet cons. It takes time to set up properly, so you have to make sure that you follow all the right steps, and it's not something that's done instantaneously. It can only be used once if spent. So once you sweep the private keys, you basically just discard them, right? So these are generally used for long-term savings. You don't want to use these for day-to-day transactions because it'll take you way too much time. If coins are lost if paper is damaged. So if you lose your paper wallet or it gets damaged, then you'll lose your private keys and therefore your coins on the network. And private keys could be exposed while sweeping the wallet. So there is one little point of failure. Even if you do it right, you will have to sweep your wallet onto some software that may be connected to an internet, and there's a point of exposure there. All right, so my favorite type of wallets that we highly recommend are hardware wallets. My favorites are Trezor and Ledger Nano S. You have other ones as well like Case and Cool Wallet, or you can create your dedicated offline computer. The reason why I like hardware wallets is because it gives you all the security of cold storage, but they're really, really easy to use and they protect you against multiple attacks. So here are the benefits of using Trezor. It's very easy to use, as easy as a web wallet. It keeps your private keys isolated on cold storage so that they become unhackable. And it can be restored with a seed in case of loss. So if it gets damaged or you lose it, you'll have 24 words that you write down on a piece of paper, and all you need to do is buy a new one, and then you can restore the wallet. And you can use it to create multiple passwords. So you can have multiple different accounts with all kinds of different passwords, and each one of those accounts will generate a near infinite amount of addresses for you. And it allows you to generate new addresses for each transaction to protect your privacy. So instead of having all your Bitcoin stored on one single address, it will automatically generate a new one for you every time you receive. So here are some various attacks that the Trezor protects against. So it'll protect you against viruses because it isolates your private keys. So if you have viruses on your computer, they won't be able to access your private keys. Theft. If someone tries to steal your Trezor, they are password protected. Loss, if you lose your Trezor, you can restore it from those 24-word seed. Extortion, if someone tries to hit you with a $5 wrench attack, so you have it all encrypted and such, but they try to extort you, you can have a whole bunch of dummy wallets with various different passwords. And also surveillance, because it's constantly generating new wallets for you. It kind of obfuscates all your Bitcoins on the public network. What are altcoins? Altcoin stands for alternative coin, which is any other cryptocurrency next to Bitcoin. Because Bitcoin's open source, anybody can use that code to create their own coin. And the benefits of this are decentralization through diversification. So because people have more choice, it allows us to have more freedom as well. There are thousands of altcoins to choose from, but many of them aren't very good, so you have to separate the treasure from the trash, and some were innovative while others were complete scams. So here are a few examples of altcoins. We first had Namecoin, which is the first fork of Bitcoin, which made it the first altcoin. Litecoin is the first altcoin created with a different mining algorithm. So Bitcoin uses an algorithm that's called SHA-256, whereas Litecoin is using one called Script. Peercoin is the first hybrid proof of work and proof of stake coin. What that means is that proof of work is you're putting your computers to work, whereas proof of stake just means you have to own coins in order to secure the network. Ethereum is the first Turing complete blockchain, and what that means is that you can program smart contracts as well as decentralized applications directly into the blockchain, and you also have privacy-centered coins such as Monero, Dash, and Zcash, which do different things to hide your transactions on their network. So let's look at some of the benefits of altcoins. One of the main benefits is experimentation and testing, so developers can play around and experiment on low market coins as opposed to putting high value coins at risk. It also gives you a freedom of choice, so if there's a certain coin or blockchain that you agree or disagree with, you could actually just vote with your money. That also gives you access to more features because with experimentation comes innovation. And as we mentioned earlier, it leads to decentralization through diversification, which also gives us more markets to trade. So when you have more markets, that also produces different opportunities and unique trading strategies that you can apply, such as cross-currency arbitrage and things like that. And you could also create tokens to raise capital as well. So because there's so many altcoin choices, you want to make sure that you do your due diligence because there are a whole bunch of different altcoin scams. So here are a few of the scams. You have undisclosed pre-mining. So this is when a developer tries to mine coins ahead of the public without letting the public know. If they're upfront about it, then it's not really as scammy because the individual can still choose if they want to participate in that. You also have pump and dump. So sometimes developers will create coins or tokens just to kind of pump them up on the market so that they can dump on everybody. Sometimes altcoin wallets are actually Trojan horse malware. So you might download a specific wallet thinking that you're getting it for your new altcoin, but it turns out to be malware that tries to steal private keys from your Bitcoin wallet or various other cryptocurrency wallets. Also, smaller networks can suffer from network attacks, so sometimes scammers will try to hack a network or 51% attack a network, and what that means is when they take over 51% of the hashing computer power on that network, then they can do things like double spend the same coins by sending it to two different transactions at the same time. And then sometimes you have fake fundraisers where developers will create a token and do a fundraiser, but they just run off with people's money instead of actually delivering on their promises to create open source software. And then you also want to stay away from most cloud hashing. Cloud hashing is when you rent mining power from the internet, companies on the internet. Many of them are actually just Ponzi schemes, so it's just best to stay away from those. If you want to get into mining, it's much better to get your own equipment. So in order to find various different altcoins, here are a couple of sites. You can go to coinmarketcap.com. CoinMarketCap will allow you to look at the price, the market capitalization, as well as the volume and various different features of the coin. And also all new coins generally have an announcement thread on a forum called bitcointalk.org. And you could also look at further specifications as well as community sentiment. So here are some of the benefits of trading altcoins. With many new coins comes different trading opportunities. Sometimes when new coins get listed on the exchanges, their prices can be very high, so you can build entire strategies around that. Also, highly emotional price action means big volatility. So that can lead to a big price range, which can give high profit potential, long and short. And there's also that opportunity of cross-exchange arbitrage of sending coins from one exchange to another, trading in and out of Bitcoin. Now, if you're going to trade altcoins, you have to understand that the most liquid altcoin markets out there happen to be paired against Bitcoin. So Bitcoin kind of acts as the main reserve cryptocurrency, and most altcoin values are measured against Bitcoin. And the smallest unit of a Bitcoin is called a Satoshi, and this is what it looks like right here. And the value of an altcoin also varies on supply. So if a specific altcoin has a really high supply, you could expect that its Satoshi value will be lower and vice versa. And then in order to be able to calculate your profit and percentage gains, you basically do that by looking at how many Bitcoins you've made or lost in a particular trade. Most seasoned altcoin traders just trade altcoins to be able to accumulate and hoard more Bitcoin.
So let's talk about how do you profit with Bitcoin and the new cryptocurrency economy. This is probably what you came here for. Let's talk about how you make money with this stuff. So why cryptocurrencies? Again, there are many ways to profit. It's, in my opinion, one of the easiest markets to trade because it's not dominated by professionals on Wall Street or high-speed computer algorithms yet. There's also no barriers to entry. Anybody around the world with any amount of money can start actively participating. The high growth potential, we've seen it be the best performing currency over the past several years, and the evolving ecosystem of innovation. Okay, so there's so much development. This is a really fast moving space. And there's also huge potential for entrepreneurs. So the development in cryptocurrencies has been incredible. And since its inception, Bitcoin startups have actually raised over $1 billion in venture capital, which I think is really incredible. And you can work for yourself and travel the world. In the new cryptocurrency economy, if you have access to an internet connection, you now have access to a global economy where you can do business internationally without paying a fee to a bank for the permission and the ability to send and receive money. Let's talk about the 5 most profitable ways to make money with Bitcoin. Number 1 is investing, and this means several things to different people. Investing could mean just buying and holding and using Bitcoin as a store of value. It could mean taking capital and investing it in something that maybe a startup that is going to have future production, right? Production value. Also trading, actively buying and going long and then turning around and shorting when Bitcoin gets overvalued. There's so much volatility, which scares the average Joe. But if you understand how to trade the markets based on human emotion, you can actually do really well by understanding when things are undervalued or overvalued. And also entrepreneurship, like I just mentioned, there's so many opportunities for development. Bitcoin and blockchain technology is already changing industries all over the world, but I'll just give you a couple quick examples. Real estate closings, the title tracking system that we have in the United States is so outdated and so expensive and just ridiculous that is open to huge innovation. Also, supply chain management, from food to anything that is sold in retail stores, to healthcare. Bitcoin and blockchain technology is going to affect every single market on the planet. Also, you can make money with mining Bitcoin, mining new coins. Also marketing. You can participate as an affiliate. You can participate as someone who buys and sells assets or markets products and services. So there really are so many angles to make money with this, and you can use your own strengths to find where you fit in here. So when it comes to investing in cryptocurrencies, I'll just start by saying this. Cryptocurrencies are a completely new asset class, which means they are very risky. There's a lot of unknowns. And so when it comes to investing, you never want to invest money you can't afford to lose, meaning you never want to take your grocery money or money you need to pay for your mortgage or rent and put that into a highly speculative cryptocurrency, right? That's not investing. That's speculating and doing it wrong. When you look at investing, you want to understand things like how to analyze the value of a cryptocurrency on a fundamental level. In the stock market, you look at things like earnings per share, you look at their debt load, there's a very simple way to look at stocks or equity in companies and kind of have an idea of what you think the value should be. It's a little more subjective in cryptocurrencies, but you can also figure out very quickly and easily which cryptocurrencies have value and which ones are just kind of scammy, because there have been hundreds of cryptocurrencies that have come out, and most of them are either copycats or really won't hold their value long term. Also, being an early adopter, people that were very early to Ethereum saw over a 15x return in just a few months. That's just one example. So if you pick the right cryptocurrency and you get in early to the game, there is a tremendous amount of upside. But also being early means there's more risk too, so you need to do your homework. Diversification, you don't need to pile into just one cryptocurrency. Bitcoin has kind of been the gold standard to cryptocurrencies, but there are also several others that have real development behind them, meaning they have really smart people working on them, trying to improve on Bitcoin's original technology. And then another thing is, whenever you invest, it's really important to think about timing and execution. Timing is everything. Just like everybody that bought gold in 2011 at the all-time highs when you had the gold bugs on TV pumping it, Bitcoin is one of those things that Warren Buffett always says, buy when people are scared and sell when people are greedy, right? You want to do the opposite of the masses, but it can be difficult to time markets, so patience is also a very, very important thing. And then adding value. If you get in on a project, if you're tech savvy, or if there's a way that you can actually participate on the development of a new cryptocurrency, that's also a way to get in early, amass an incredible amount of value, and that way when it goes public, your investment could go up by many, many hundreds or thousands of percent. So when it comes to trading, there's actually 4 different time frames, okay? The first one is what I call scalping, where you're just kind of like erratically in and out of a market very, very quickly. The next is day trading, where you get in and out of a trade within the span of one day. That might mean 5 minutes, that might mean 5 hours. Swing trading is where you typically get into a trade and you hold anywhere from 2 days to 2 weeks on average. And then anything outside of that, I kind of look at as longer term investing. And one thing I'll say is the shorter the time frame, typically the more difficult it is. So people that hyper scalp typically lose a lot of money. Also with day traders, this is actually my background, where I came from the financial markets, and I just saw more than 99 out of 100 people lose all their money trying to day trade. But I think in cryptocurrencies, if you can understand swing trading and understand how to catch the big moves in a market, that's where you can do extremely well. And that's where I've made some of my money, is in swing trading and then also in investing. So there are benefits of actually combining the two strategies, trading and investing. Number one, it increases your profit potential if you understand how to catch the big swings, either up or down. People that just buy and hope, sometimes you get lucky and you do well, but if you understand fundamental analysis, if you understand technical analysis and how to read charts, that can really give you a huge edge over the masses. So I actually like to build strategies and have an approach for all of the time frames, long-term and shorter term. Longer term holdings prevent what we call FOMO trades, or fear of missing out. Bitcoin, when it was down at $200, I was being really loud to all my friends and family and followers about how I thought this was a really good value, but nobody wanted to hear it. Whenever I start to get hit up by people that ask me, is now the time to buy, is usually after the price doubles or triple. So you want to really think long term and know when it's the right time to buy, so you don't have those fear of missing out trades. And then the potential to add to long-term holdings with trading profits, that's a really big benefit. If you're trading in and out short term, stacking your capital, that's going to give you the ability to hold for even longer term on a much larger position size. Okay, so I want to actually invite you to a masterclass where you're going to learn how to create income and build wealth with Bitcoin in the new cryptocurrency economy. So, in this course, we wanted to give you kind of a high-level overview and introduction into Bitcoin. And on this masterclass, we're going to do a deep dive into the top 5 ways to make money with Bitcoin and show you examples and answer your questions. We'll have time for some live Q&A. And also, you'll learn how Rocky has actually lived off of his Bitcoin profits solely for the past 3 years. It's a pretty incredible story. And also 3 ways that entrepreneurs are using Bitcoin as a profit booster. And I'm really excited about this as an entrepreneur and an investor myself. Bitcoin has really just helped me not only save money, but also make a lot more money with this kind of hungry new economy that we have right now. So I think we are just really hitting the tip of the iceberg. So I know you're going to love this masterclass. We'll put a link below this lesson, and you can go ahead and click that and make sure you're registered. And if you have any questions from this course, you can ask them there, and I know you're really going to love it. So thank you again for taking this free course here on the Skill Incubator. If you have questions, feel free to reach out. Otherwise, I will see you on the masterclass. Take care. So what is Coinbase? Coinbase is an online hosted wallet, and it's an American-based company, and they're out of San Francisco. At the time of this video, they have over 600,000 or 700,000 accounts, over 16,000 merchants actually using Coinbase to accept Bitcoin for payment. And they integrate with U.S. banks. So, for example, you can plug your checking account into Coinbase and buy Bitcoins relatively quickly. So how to set up a Coinbase account. Number 1 is go to Dunn.ly, so D-U-N-N, like my last name, .ly, /Coinbase-free. And I've got the links in the description below, but if you click that and you sign up for an account and fund it with at least $100 worth of Bitcoin, then Coinbase will give the both of us $5 in Bitcoin. So that's pretty cool. And what you'll do is you'll register for an account, and there are 2 different verification levels, and I'll show you how this works in a second. I wish everything was instantaneous and you could just buy as many Bitcoin as you want overnight really quickly, but there is a little bit of a process that you go through, but it's worth doing it sooner than later. That way you're not kicking yourself if Bitcoin prices go up or if you miss any really good profitable trades. So just go ahead and do this while you can. And then what you'll do is after you make your verifications, you'll activate the ability to buy Bitcoin instantly. So when you go to Dunn.ly /Coinbase-free, this will bring you to the sign up page, and just go ahead and click on sign up. You'll create your username and password and go through that process. So there's actually 2 verification levels, and I'll take you through each one and show you what they mean and what you get with each verification level. So in level 1, this is where you have to do a few things. You verify your email address. So this is easy. You just click a link with a confirmation email. You verify your phone number, and this is important. It really kind of adds a second level of security. And then number 3 is you link a bank account. Now, some people don't want to, put all their information through these online exchanges, and they just want to buy, peer-to-peer or from person to person, and that's okay too. This is for somebody that, if you want to be a trader of Bitcoin, or if you just want to have instant access to the market. I feel fine with Coinbase and a lot of the other exchanges, but again, they are going to ask for personal information for you to be able to use this information. So, that's level 1, and what that will get you is a daily buy limit of 10 Bitcoins and a daily sell limit of 50 Bitcoins. And what will happen is it actually takes, I believe, about 4 days for the Bitcoins to arrive when you make your first purchase. Okay, so it's not like you can buy and sell right away on your first transaction. So I recommend that you go ahead and do level 1 as quickly as possible so you can get the clock ticking. And then after 30 days, you'll be eligible for level 2. But you do have to wait for 30 days after you buy your first Bitcoin. So just go ahead and link it all up, buy, a little bit of Bitcoin just to get yourself started, and then what you'll do is on level 1, I believe you get 0.1 Bitcoin instant buy. So after you do your first purchase, you can buy some Bitcoin instantly, but you just can't buy a lot of it very quickly. And they do this for security reasons. But Level 2 is when you complete a purchase and you wait at least 30 days, like I mentioned, and then you verify your identity by sending in some information. A lot of these exchanges want two things. They want ID, or proof of who you are, and then number 2, proof of residency. So kind of like a utility bill or something like that. And what this will do is it will give you, I believe, up to 10 Bitcoins instant buy, so you can buy and have them in your account right away. I think Coinbase is a really good place for buying your first Bitcoins, but it's not necessarily the best exchange for day trading. So as of the time of this recording, Coinbase is available in 33 countries, and I know they're working really hard to be able to operate in as many countries as they can, obviously, because that's their business and they want as much business as possible. But if you scroll down, you can see which countries and areas they are able to work in, and if you're able to buy and sell. Unfortunately, in Canada, they removed the ability to sell. And so, just keep an eye on this. And also, this is a moving target because the regulation in Bitcoin is constantly changing. And so, I know New York and Hawaii here in the States have had issues just because of local governments and regulators thinking they know what's best for people. So, just check this updated list and see if your country fits here. If not, don't worry. There are exchanges and places that you can buy and sell Bitcoin pretty much anywhere around the world. Coinbase just happens to be a pretty good option that I like here in the States. And you can see, in Asia, Australia, Europe, and North America, they have options. So we do have other tutorials in this course for you. So I highly recommend checking those out. And if you have any questions, please reach out to us.
All right, in this tutorial, I'm going to show you how to use BitMEX. BitMEX is a Bitcoin and crypto derivatives exchange. It allows you to be able to trade futures contracts on Bitcoin as well as a handful of various different altcoins. So the very first thing that you're going to want to do is register an account. You produce your email, strong password, country, and first and last name, and then the CAPTCHA. Now, this service isn't available to US citizens as a result of regulation, so make sure that you're able to trade on this exchange through your local jurisdiction. So this is just a demo account. I deposited a couple of dollars worth of Bitcoin to throwaway address. And the interesting thing with this is that you can only deposit and withdraw Bitcoin. So although you've got all these other cryptocurrency markets, Bitcoin is always used as your base collateral. So the very first thing you're going to want to do is set up two-factor authentication. And you do that by going here. Click on Account and Security. Then where you see Enable Two-Factor Authentication, you can choose a type. So in this case, I'd choose Google Authenticator, which I highly recommend. And then you download the app on your phone. You take a picture of this QR code. It'll generate a code for you and you hit submit, and what this will do is it'll generate a secondary password for you. So if someone cracks your password, they need physical access to your phone to be able to generate that secondary password and get access to your account. So once that's secure, then you can deposit money into your account. So you just click over here under the deposit address and you can just copy and paste this and send it from your wallet or take a picture of the QR code. Once the money, it takes about one confirmation for it to show up in your account. And as far as withdrawals are concerned, for extra security, they only process withdrawals once a day and they do it manually for extra security. So let's look at some of these contracts and how you can trade some of them. So my favorite contracts here are the Bitcoin contracts. Now, you have ones that are called perpetual swaps, which are considered daily contracts. You can go up to 100x leverage, so you can go up to 100 times your deposit account. These contracts are very simple. Every single contract is worth about $1 worth of Bitcoin, right? And the reason why these are called perpetual swap is because there is a maintenance fee every 8 hours that needs to be paid to either longs or shorts. And you can see the funding rate down here. It'll show you the funding rate. When it's in the positive, it means that longs, people who bought Bitcoin or bought contracts, end up paying. So it's in 3 hours that expires. You'll end up paying people who went short, right? And when it's in the negative, it means that people who shorted, which just means selling contracts, will have to pay people who went long. And oftentimes you'll see this, you'll see longs pay shorts more often than not, but there are times where shorts have to pay. The reason being is because in order to be short on Bitcoin, you're still using Bitcoin as your base collateral, right? So let's say you're only short 1x leverage. Well, that would just be a hedge, and you'd just be locking into dollar value with exactly what you have in your deposit account, right? So if the price goes down, you'll still have the exact same amount of dollars. You'll just have more Bitcoins to match that. Or if the price goes up, then you'll have less Bitcoin, but you'll still have the exact same amount of dollars. So in order to go beyond just a hedge and make it profitable, you need to use more than 1x leverage to do that. Now, you want to make sure that you go really, really easy on the leverage. If you go 100x on the leverage, then you could double your account on a 1% move, and you could also lose everything in your account on a 1% move. And you have this feature right here, which is isolated leverage. And how this works is it almost acts like a stop. So if I were to go, if I have a couple of dollars in my account, but let's say I were to use low leverage. Let's say I didn't go a full, use my full capacity of leverage, right? So as an example, imagine I had $1,000 worth of Bitcoin in my account, but I only, let's say I short $300. So I'm not even using one-to-one leverage. Well, if I wanted to isolate that as a stop, I could use what's called isolated leverage. And let's say I went 10x on that isolated leverage, it would treat this $300 as if I'd gone 10x on the leverage. Even though I'm not even one-to-one leverage, it would isolate and treat that as if I'd gone 10x. So if the market moves against me a certain percentage, it'll automatically liquidate and close out that specific position. And what this will do is it can protect your main account. For the most part, I just use cross, and I just generally use the leverage that I want. Cross allows you to set whatever leverage you're capable of using. So let me show you an example of perpetual swap. Now I deposit a very small amount of Bitcoin in here, just a couple of dollars, but I'll show you how to short. So just like other exchanges, you have your limit, right? So it'll only execute at a specific price. So if I wanted to limit sell at, let's say 1070, wait for the price to go up, and let's say I limit sell 3 contracts, so that would be shorting. So it'll show my active order right here. So it'll show the quantity of contracts that I want to sell, the price, the order value, and then the type and the status, right? And of course, I could just cancel this at any time to cancel order. So that'll set a limit order. But let's say I wanted to execute really quickly. So I'll use BitMEX a lot for scalping. Oh, and the interesting thing too is that when you market make and set orders on the book, you'll actually get paid fees. If someone executes your order, you'll get paid fees. So market makers get paid fees, and market takers, people take orders off the books, have to pay fees. So, sitting orders on the books, that could be a way of generating some passive income. Now, let's say I just wanted to short immediately. I'm just going to short I'll short 2 contracts, right? So I'll just set a market order So that shows me that I shorted 2 contracts, shows me the price, the value, right? The mark price. So this is based kind of like on a weighted average across exchanges. And then it shows me my liquidation price for where the price of Bitcoin has to go. So obviously, I have no risk of liquidation right now. It would have to go extremely high. And then it shows me my unrealized profit and loss, which is so minuscule right now, it's not really showing anything because it's only a couple of dollars. And so you could close out your position. And if you want to close it out immediately, you just hit here as a market order. And that'll immediately close out. So I wanted to use some leverage on this. So let's say I short 10 contracts, which would be equivalent to $10. It actually shows me how much leverage I used on that right here, right? So it's showing that I used 4.79x leverage on that trade, right? So obviously, like the liquidation price now is lower. So if the price hits 13.30, I get liquidated and I lose what's in my deposit account. So I'm just going to market close that. So that's how you would short. And longing is just doing the opposite with a buy order. Now here's another type of contract. Let's say you didn't want to play the maintenance fee games. I mean, if you were in a nice short position, that could work in your favor because you could collect fees on it. They also have these March 31st contracts right here, and these are interesting. So these expire. So instead of a daily swap fee, there's no fee except for executing the order. And they have an expiry date. So these expire on March 31st. So whatever the price is on March 31st is where my order will get closed at. Now, you don't have to hold your orders till then. I mean, you can buy and sell as much as you want between now and that time, but it does have an expiry, right? And so now you could see other markets as well. This is like the Bitcoin yuan if you want to trade Bitcoin against the yuan, or if you want to trade Bitcoin against the Japanese yen. This Japanese yen has 100x leverage. With the yuan, they have 100x leverage. You can play with altcoins. So as you can see here, this is Zcash. It behaves just like buying and selling regular altcoin markets. The only difference is this isn't spot. So obviously you have to be mindful of leverage and liquidation stuff. So it does come with more risk than just trading altcoins on the spot markets, because with spot you could end up bag holding, but you'll still get to keep your coins. Whereas with futures contracts, if the markets move against you and you bag hold, you could lose everything that's in your account and get nothing. You actually don't control any coins. These are just all synthetic contracts. But because there's not enough liquidity in a lot of these altcoins, they offer much less leverage. So they're not going to give you 100x on an altcoin market that doesn't have the same liquidity as Bitcoin. So, and this expires March 31st, gives you 5x. Ethereum expires every 7 days. A little more liquidity, a little more leverage, 33.33. Ethereum Classic every 7 days, 20x. Monroe's 25x every 7 days. You could see same value unit measurement as just trading on the spot markets. And it'll show you all the recent trades here. As you can see, you have nice charts here that you can use. You also have like order history. It'll show me all my orders that I just executed. Stop orders, which behave the exact same as any other stop order. And again, stop orders are used to kind of protect you, to get you out of bad trades. Every 7 days for Ripple, 20x. Then you've got Augur, 10x, Litecoin. So these are all 7-day contracts, 33x. Factom, 20x, Dash, 20x. And then now and again, they have these speculative instruments. Like you can bet on whether or not you think the Bitcoin ETF is going to get approved. So oftentimes they'll have these novelty speculative contracts or instruments for certain types of events. So they are quite unique. BitMEX definitely does have the best trade engine. I've never had BitMEX freeze on me during trades. I use BitMEX predominantly for scalping just because they have such fast execution and because the fees are fairly low as well. So that's it for this tutorial, and I'll see you in the next. Cheers. All right, so in this tutorial, I'm going to show you how to use Poloniex. Poloniex is one of the biggest altcoin exchanges around, and they also tend to determine price discovery for some of the top coin markets. So the first thing you're going to want to do is click on this tab to create an account. Put in your name, your country. You don't have to give your phone number. You could give your email address. Make sure that you're using an email address that's not public, just for extra security. Strong password. You want to make sure you use at least 16 characters with numbers, letters, capitals, and special symbols, things like that. And then you'll have to verify your email. They're going to send you a verification code, and you just click on it to verify your email. All right, so once you're logged in, the very first thing you're going to want to do is set up two-factor authentication. This is extra security. So what you'll do is you'll download an app called Google Authenticator, and then you scan this QR code, and it'll generate a special code for you that you'll have to confirm with your password and code to enable it. And what this does is it secures your account. So if someone cracks your password, they need to actually get physical access to your phone and get that secondary passcode that'll get generated. So let's look at trading and some of the trading options. So you have various different tabs here. You have exchange, margin trading, and lending. So under exchange, these are all just spot markets. So as you can see here, you can see all the different types of markets here. You have the coin. So this is the abbreviation of the specific market. So this would be Monero, Dash, Ethereum, Golem, Ripple. You have the price. The price is all measured in Bitcoin value, at least for this exchange here. You can get prices pegged to the US dollar using Tether, also known as USDT. But you definitely want to trade on markets that are the most liquid. So obviously there's some liquidity here for Bitcoin and such, but some of these other ones aren't as liquid. The majority of the most liquid markets where price discovery is determined are generally paired against the Bitcoin markets. So it'll show you the volume. This will show that Monero traded over 4,000 Bitcoins in trading volume. So, several $1 million. It shows the price paired in Bitcoin. It'll show you the percentage change, 24-hour percentage change. And this isn't always accurate. I've seen times where it wasn't accurate, but for the most part, it'll just give you a quick overview and then the full name of it. So let's say I wanted to purchase a coin. Let's go with purchasing some Ethereum as an example. So we have the order book here. We have the buy orders. It shows the buy support. So there's over 1,000 Bitcoins in buy orders. So these are the bids and these are the asks. These are sell orders. This is the amount of Ethereum that people are trying to sell. And as you can see, the markets and the price are moving quickly. As I scroll down, it'll show the market depth between buys and sells. It'll show my open orders on the books. It'll show the trade history so you can watch the order flow of trades being executed. And you can click on this for my trades. Now, I don't have any trades because this is just a demo account. But what I do have is I did deposit just a couple of dollars of Bitcoin just to show you how to execute a trade. So I'm just going to be doing a market trade. So I'll just pick a price down here. And it'll give me the best fill for the price. Now I can only trade what I have in my account, which is a couple of dollars. And that'll allow me to buy 0.16 of Ethereum or Ether, and it executes immediately. So that's a market order. You know, I could do the opposite too. I could just set a sell order. So let's say I want to sell it for more expensive. Let's say I want to sell it for 15 instead of 12. Then I can just put down the amount that I want to sell it for and how much I want to sell. And that'll just stack an order on the book for me. So as you can see here, my open orders, it shows the price I want to sell at, the amount, the total Bitcoin that I would get out of that trade. And if I want to cancel it, I just hit cancel. And so now you also have stop orders, right? So let's say I wanted to get stopped out of a trade. All right, so to set a stop, I put the stop price where it gets triggered. So if the market moves against me to 0.011, right? So if it drops, then it'll trigger my stop, but it'll set a limit, and this is for slippage. So if you have like a large order, you want to set a limit. It'll sell up to this price, and then it'll show amount. In this case, it's only a small amount, so it would likely execute immediately. But so that's the difference between just setting the stop where it triggers and the limit fill up to this price. So it's showing me if the highlight bid drops to or below 0.011, in order to sell 0.165 ETH at a price of 0.01 BTC will be placed, right? So that'll ensure that my order gets executed with the least amount of slippage, because sometimes if the market's moving fast and you have a big dump, your order might not get executed at all. So that's what that stop limit is for. So I'm just going to cancel this. And I'll show you how to transfer funds. So now that's exchange, and you could trade on the Ethereum markets, the Monero markets, and the USDT. But I like to just stick with the Bitcoin markets because they're the most liquid. So if I want to transfer balances between exchange and margin, for example, I just click on transfer balances. I just have to do agree. All right, so click on that, exchange to margin. Actually, let me do Ethereum since there's more. All right, from exchange to margin. And now I just go on the margin trading tab. And I have various different markets. Not every market that they have is available for margin trading. So what margin trading is being able to use my base as collateral to be able to borrow more coins, right? So I have up to 2.5x leverage, so I can borrow 2.5 times my deposit, right? And what that deposit does is ensures that the market cannot move past a certain percentage. If it moves against me by a certain percent, then I'll get liquidated and lose that deposit. And this ensures that the swap lenders, which are the people lending the coins, will always get their money back. As long as the exchange stays solvent, they don't have any risk on the line from traders taking risky trades. So I'm going to show you how to short Ethereum. So shorting is just borrowing Ether and being able to sell them on the market. And so if the market moves down against me, then I can buy back those Ether at a lower price. The swap lender gets back their principal with the interest, and I get to skim the profit in between where I sold and where I bought back in. So if I want to sell and go full full size, I just click on that. And let's just pick a price that'll get me filled at. And then margin sell. Okay, so it's saying my collateral, I don't have enough collateral for that size. So let me reduce the size here a little bit. Sometimes you have to just kind of do this in increments. Even though it's telling me I have that much ETH, sometimes you need to do it in increments. It won't allow you to execute it all at once. So let's just short sell 0.11 ETH. So as you can see here, it says I've sold this amount of ETH and the order was placed and executed. So it shows that I'm short, tells me the amount that I'm short, tells me the base price, the estimated liquidation price. So if the market moves up to 0.026, which is pretty far away, then I would lose everything in my account and get liquidated. It shows me my unrealized profits and loss. So I'm starting off at a negative by 954 Satoshis. And then it'll show the unrealized lending fees. And this is just, this is basically just the fees that I have to pay in interest for borrowing the coins. So now that I shorted, let's say I just want to set an order on the books to close me out once it hits a certain price. So let's say if it falls to 0.010, for example, I want to close out and take some profit. What I will do is I'll just set a buy order for the amount of ETH. So it would be 0.1105 2320, and I can just set a buy order. And so what that'll do is it creates like a one cancels the other, OCO. So as soon as the price hits that value, it'll close out my order and profit automatically. So I don't really have to pay attention. Now, I could set a stop as well. If I don't want the market to go against me, I can set a stop exactly the way I demonstrated before, right? And let's say I just wanted to close out quickly out of my trade. Then all I have to do is hit close right here. And it just closes me out. And that's that. So that's how you short an altcoin, and longing is just the opposite. You just buy. Now I'll show you one last thing with Ethereum, which is the swap lending. So again, I'll have to transfer balances, and so I'll go from margin to lending, and then transfer. So if I look at the lending, I could see BTC lending. So people are lending Bitcoins. This is the rate. So they're offering loans for, this is daily interest. So they're offering loans at 0.0196%. So the compound interest, obviously that could add up. If you're okay with the counterparty risk, you could just do lending, which is less riskier, and just earn some passive income on your Bitcoins. And if I wanted to lend Ethereum, there aren't any loan demands on the table, so I would have to just make an offer and then set it up for the amount of days. And if I do auto renew, it'll just keep on renewing every 2 days. And I could put any amount of days that I want. Obviously, you know, someone here's got 2 to 10 days. And then it puts my offer up. So if I wanted it to get lent out immediately, I would give a reasonable offer that surpasses everyone else's offer so that it gets scooped up a lot quicker. For the most part, sometimes if one of these markets are in high demand, like if they really rally and they're illiquid, sometimes the loan offer can go up quite significantly. if people want to short it and there's not a lot of demand. So you can actually, if you see one of these markets pumping, then you can buy some coins and then lend them out so that people can short. But obviously there's some risk, because if the markets crash on you, then you can lose money. And that's why the percentages are much higher when people want to borrow and the markets go parabolic. For the most part, the most stable way of doing this is just through Bitcoin. And you can go here. So now that you know the three elements of this exchange, you can look at deposits and withdrawals. So this will show you everything you have, and you can basically, deposit any coin you want. So if you wanted to deposit BitShares, for example, it'll generate a code. If I want to withdraw, then, same thing. I have to put in the address. In this case, there's a memo that comes with the address, the amount, withdrawal. Then it'll send you a verification email and also ask for your two-factor authentication. And that's important. You want to make sure that you do that. And then you can also look at your history. So it shows the deposit withdrawal history. I can look at trade history and analysis. So it'll just show me all the trades that I just took. And it'll show you all your trades. So if you need to calculate, you can look at it by dates and you can add your coin and such. So if I were to look at Ethereum and analyze, it's showing that I have a loss of 0.0019, which I actually don't think is very accurate, because that's all I have in my account. So yeah, I'm not sure if their trade history section is quite accurate at calculating this. But you'll have all your raw history right here. So that's it for this Poloniex tutorial, and I'll see you in the next video. Alright, so this is a tutorial on how to create a cryptocurrency wallet so that you can hold Bitcoin and various different types of altcoins. So here's a website called Qzx900, and they provide a wallet that you could either use on your phone, desktop, as a browser extension, and they have all the different types of operating systems, and they'll have a hardware wallet support soon. My preference is to use hardware wallets like Trezor and Ledger Nano S because they're more secure, they're unhackable, but until you get a hardware wallet, this is also a good option in the meantime. So once you download it, I just downloaded, for demo purposes, I just downloaded the Chrome extension, which is just up here. So when I open up the wallet, you can see a bunch of various different currencies up here. So this is Bitcoin, you've got Ethereum, Dash, Ethereum Classic, Rep, Litecoin, Zcash, so on and so forth. To send a transaction or to receive a transaction, if you want to, let's say you buy some Bitcoin and you want to send it to this wallet, pull it off the exchange, so you could just hit on the receive button, and this is the address. So you just copy this address, and if you need to do a withdrawal somewhere, you can just send it to this address that you copy. Now if you want to send Bitcoin, so let's say you want to send a few Bitcoin to an exchange, what you would do is you'd hit on deposit. So as you can see here, this is just BitMEX, and I'll share a link for BitMEX under the video. Click on deposit, and then you can just deposit Bitcoin into this address. So this is a receiving address. So just click on send, put in the receiving address, paste, and then you just type in your amount, so on and so forth, right? So there's various different types of features that you have. You can go over here in settings. You can set up a security pin, which I highly recommend. This will basically, you know, if someone accesses your computer, they'll need to know your 4-digit pin. You have settings here. Sorry, not settings, tools. So you could back up your wallet. This is important. So what this will do, if I click on backup, it'll give me a backup phrase. So this is a private key. Don't share this with anybody. Don't store this on your computer or anything like that. Write this down on a piece of paper. If anybody has access to this, they'll be able to basically take all your Bitcoin, right? So this is you know, wallet backup. So if you lose your computer or if something happens with this wallet, you can take this backup phrase and you can plug it into, re-download the wallet, plug it into, or put in another wallet, and all your coins and addresses and such will appear. Because nobody actually owns coins or stores coins on their computer. All coins are stored on the blockchain, and private keys allow you to unlock and access those coins. So that's definitely an important feature. And then you could also transfer a paper wallet. So if you created a paper wallet somewhere, you can basically import your private keys into it, right? I'll just show you what private keys look like. It could either look like that phrase, or it can look like a hash code. So here's an example of public and private keys. So this is a public key pair. So this is what you want to share with people if you want to receive Bitcoin. And you don't really have to do anything in these wallets for your private keys. It'll automatically just manage all that and send the coins out for you. But if you need to see your private keys for whatever reason, if you needed to import this into another wallet, this is what you do, right? And if you had a paper wallet, you would just copy and paste this, and then you would import it into the paper wallet section, and then your coins will appear in this account, in this wallet. So a couple of other things that are really important. When you sign up for an exchange, any exchange, it's very, very important that you set up what's called two-factor authentication, right? Enable two-factor authentication. What this does is it generates a secondary passcode. So there's an app called Google Authenticator. And what this will do, what you do is you click on this, you download Google Authenticator on your smartphone, you take a picture of this QR code, it's going to give you 6 numbers, you submit them, and these numbers refresh every 1 minute or so. So every time you log into your account, you'll need to put in your password, and then you're going to have to put in those 6 numbers that are freshly generated off of that app. This is if someone hacks or cracks your password and gets access to your password, then they need to also get physical access to your phone. This is an absolute must for any exchanges. If you don't do this on the exchanges, there's a high probability that your coins will get hacked, and that's no fun. Also, when you set up an exchange account, you want to make sure that you use a very strong password, minimum 16 characters. Do a combination of numbers, letters, and symbols with some capitals and stuff like that. So just make sure it's a very strong password, no weak passwords on anything. Don't reuse the same password over and over again, and ensure that whatever email that you use that's linked to your accounts, make sure that those accounts are backed up or have two-factor authentication on them as well, right? So that if someone cracks your email account, then they also have to get access to your 2FA as well. So hope you enjoyed that video, and I'll see you in the next. Cheers.